In this video, we're going to go over Chapter 3 examples for business finance. In Chapter 3, we talk about financial statement and ratio analysis and other financial statement analysis. So each one of these problems is going to look at some form of financial statement ratio calculations. So this first example, we have information about a company. We're given their net working capital, their current liabilities, and their inventory amount. And we want to calculate what is the current ratio and what is the quick ratio. In order to calculate both of those, we need the current assets number. So we have to calculate current assets. If we know that net working capital is current assets minus current liabilities, then we can rearrange that equation to calculate current assets. So net working capital equals current assets minus current liabilities. So current assets equal current liabilities plus net working capital. So current liabilities plus net working capital gives us our current assets. Our current ratio then is current assets divided by current liabilities. So we take current assets and we divide by current liabilities. We have a current ratio of 1.4. This means that our current liabilities are higher than our current assets are higher than our current liabilities. If we had a negative net working capital or our current liabilities were higher than our current assets, our current ratio would be below 1. What the current ratio tells us is if we have enough assets on hand, current assets available to us to cover our current liabilities for the upcoming year. The quick ratio or acid test ratio removes inventory from that calculation for current assets. It focuses on quick assets, which are cash and accounts receivable. So assets that can quickly become cash. Inventory is not considered something that can quickly be turned into cash because we have to have somebody buy it for us. We can't guarantee how much time it takes. So for the quick ratio, we are going to take current assets minus current liabilities, or minus inventory, and divide by current liabilities. So our quick ratio is 0.94. What this tells us is how dependent a company is on selling inventory in order to earn cash. Our quick ratio is almost 1. So that tells us that we have enough cash and accounts payable on hand to pay for 94% of our current liabilities, meaning that we are not very dependent on the sale of inventory in order to be able to generate cash. In this second example, we're going to look at the net income return on assets and return on equity. So we start with knowing that the profit margin is 6%, and we need to calculate net income. Well, remember that profit margin is the amount of money that we get to keep from sales after we pay all of our expenses and taxes. Profit margin is calculated by dividing net income by sales. So net income divided by sales. So in order to calculate what the net income is if we just have sales and profit margin, we would take sales times profit margin. And that gives us a net income of $912,000. We can now calculate our return on assets. Return on assets is net income divided by total assets. And our total equity, we're given total assets and total debt. So we can use our accounting formula to generate our total equity. Total assets equal total debt plus liabilities. Therefore, assets minus debt equals total equity. assets minus our debt or liabilities equals our total equity. Our return on equity is net income divided by equity. So our net income divided by equity. And these look at how well we are using our assets and our equity in order to generate income for the business. In our third example, we are looking at receivables information. So the first is the receivables turnover. Receivables turnover is calculated by taking credit sales and dividing accounts receivable. So we divide credit sales by accounts receivable. We get a value of 12.88. This means on average, our accounts receivable is turned into cash 12.88 times per year. The number of days in receivables tells us on average how long it takes for credit customers to pay off their accounts. That is calculated by taking the number of days in a year and dividing by the turnover. So we get 28.35 days. So the average collection period for this company is 28.35 days. That's how many days on average it takes us to get cash from our customers after a credit sale. Our next example is inventory turnover. This is very similar to accounts receivable turnover, except we're looking at information related to inventory. Inventory turnover is cost of goods sold divided by inventory. Cost of goods sold divided by our inventory account. So this company on average turns over their inventory 15.59 times per year. So that's an average for their entire stock of inventory. The days sales in inventory is the number of days in a year divided by the turnover. On average, a unit of inventory sits on the shelf for 23.41 days before it is sold. In example 5, we're looking at the debt and equity ratios. We have the total debt ratio. We don't have any numbers. So we think, okay, we don't have any numbers to calculate the debt to equity ratio and the equity multiplier. Well, we do have the total debt ratio. If we use our accounting equation, we know that assets equal liabilities plus equity. If assets is 100% and our debt is 43%, that means that our equity is 100% minus 43%, 57%. So if we have a debt ratio of 43%, then our equity ratio is 57%. The debt to equity ratio is the debt ratio divided by the equity ratio, or total debt divided by total equity if we had a balance sheet to give us numbers. So debt divided by equity. So we get a debt to equity ratio of 0.75. The equity multiplier is either calculated as total assets divided by total equity, or 1 plus the equity debt to equity ratio. Both of those calculations will give you the same value. In this example, we're going to be doing market value calculations. So market value calculations are looking at stock information, how much net income we generate per shares of stock, how much dividends we pay per share, etc. So we have information and we need the net income in order to calculate a lot of these. So the net income is, we know that net income for our retained earnings equals net income minus dividends. Move that so it doesn't overlap. So retained earnings equals net income minus dividends. So if we need the net income and what we have is the addition to retained earnings and cash dividends, we can add these two amounts together to get our net income. So retained earnings plus dividends. Earnings per share, or EPS, is calculated by taking the net income divided by the number of shares outstanding. We have our net income here divided by the number of common shares outstanding. That gives us an EPS, or earnings per share, of $1.97 per share. So that's the amount of net income per share outstanding. Dividends per share is the amount of dividends paid per share. That's the total cash dividends divided by the number of shares outstanding. We have cash dividends of 175,000 divided by our common shares outstanding. So every person who owned a share of our stock received 52 cents per share in dividends in the last year. The book value per share is the amount of the book value of our stock outstanding. So the book value is what our total equity is on our balance sheet. The balance sheet reflects book value for accounting value. So our total equity divided by the number of shares outstanding gives us the book value per share of stock. Our market to book ratio is the market price per share divided by the book value per share. So we have the market price per share of $46 divided by our book value per share that we just calculated. This tells us that the market value is currently 2.26 times higher than our book value per share. We would expect the market value to be higher than the book value because book value reflects historical cost. PE ratio stands for price earnings ratio. Price earnings ratio looks at the market price as compared to the earnings per share. So the calculation for that is the market price divided by the EPS, or earnings per share. The PE ratio is 23. The market price of this stock is 23.31 times higher than the earnings per share. The PE ratio can indicate how expensive a stock is considered on the marketplace. Sales per share is the amount of sales generated per share of stock. This is total sales divided by the number of outstanding shares of stock. Our sales per share is $45.97. The PS ratio is the price sales ratio. This is the ratio of the market price per share to the sales value per share. As our market price is $46 and our sales per share is $45.97, the PS ratio for this company is 1. In example 7, we're looking at a common size balance sheet. So first we're going to make a common size balance sheet for this mining company for 2 years, and then we're going to calculate some of the financial ratios and look at its DuPont identity. So first we're going to look at a common size financial statement. So So remember on the balance sheet that common size means that we show every item on the balance sheet as a percentage of total assets. Total assets is 100%. That means everything on the balance sheet is divided by total assets. In Excel, we can lock that total assets cell and copy those values down to show everything as a percentage of total assets. Take everything divided by total assets. Common size financial statements allow us to make comparisons from one year to the other. They allow us to compare our own company internally from one year to another. They allow us to compare ourselves to other companies, and they allow us to make financial projections about the future. Our current ratio, remember current ratio is current assets divided by current liabilities. Current assets divided by current liabilities. The quick ratio, current assets minus inventory divided by current liabilities. Current assets minus inventory divided by current liabilities. Total current assets minus inventory divided by total current liabilities. And cash ratio is cash divided by current liabilities. So how much of our current liabilities could we pay if we did not create any more cash for the rest of the year? So we see it's 8%. We could pay 8% of our current liabilities. These numbers show that we do not have a strong short-term liquidity stance. Our current ratio is below 1, which indicates that we have a negative net working capital. We have less assets than liabilities over the year. The quick ratio indicates that we're heavily dependent on our ability to sell inventory in order to pay off our debts, and we could only pay 8% of our current liabilities with the amount of cash that we currently have on hand. The debt to equity ratio is total debt divided by total equity. So we need to add our current debt plus long-term debt and divide by total equity. So current debt plus long-term debt divided by total equity. So we see that we have more debt than equity. Our equity multiplier is total assets divided by total equity, or 1 plus the equity multiplier, or the debt to equity ratio. And the total debt ratio is total debt divided by total assets. So our total debt divided by total assets. So we can see that we have 59% of our assets are paid for by debt. The last item that we want to look at is the DuPont identity. DuPont model uses 3 calculations to calculate the return on equity. So we have the profit margin, the asset turnover, and the equity multiplier, or our total assets. It's also called leverage. Our total assets divided by total equity, which is the equity multiplier. Total assets divided by total equity. Profit margin is net income divided by sales. Asset turnover is sales divided by total assets. So we're calculating for 2019, so we need to make sure we grab 2019 total assets. And the equity multiplier, or leverage amount, which is total assets divided by total equity. Total assets divided by total equity. Return on investment is profit margin times asset turnover times the leverage. It can also be calculated as net income divided by total equity, and you will get the same exact result. 18.73%. The last example we look at in chapter 3 is the growth model. So how much can a company grow based on their retention of retained earnings, their net income that they put into retained earnings compared to their dividend payout ratio? We have an internal growth rate. Internal growth rate happens when a company wants to grow just from their ability to generate retained earnings. They have no desire to take on additional debt, meaning they're only wanting to fund themselves internally. Sustainable growth rate is if a company will take on debt, but they want to maintain a constant debt to equity ratio. So what we need for those calculations are the payout ratio, the dividend payout ratio, and the retention ratio. The dividend payout ratio tells us what percentage of net income we pay out in dividends. The retention ratio tells us what we keep of net income to add to retained earnings. The dividend payout ratio and the retention ratio should add together to equal 1, which is 100% of net income. So if our dividend payout ratio is 40%, our retention ratio should be 60%, or 0.6. We also need to know what our return on assets is. The return on assets is net income divided by total assets. And our return on equity. Return on equity is net income divided by total equity. Internal growth rate is calculated by taking the return on assets times our retention rate divided by 1 minus the return on assets times the retention rate. So return on assets times retention rate divided by 1 minus return on assets times the retention rate. This says that the most we can grow if we don't take outside funding on as debt is 10%. That's our internal growth rate. If we agree to take on additional debt but maintain our current debt to equity ratio, that is our sustainable growth rate. That is calculated by taking the return on equity times the retention ratio divided by 1 minus the return on equity times the retention ratio. If we are willing to take on outside funding, we can grow at a faster rate than if we're dependent on how much we save in retained earnings. So debt does help us to grow faster. However, if we want to maintain our current debt to equity ratio, our growth rate is sustained at 15.5%.